I've been trading for over 6 years, and it took me 2 of those years to become profitable because I failed to understand that I needed to take responsibility. In episode 1 and episode 2 of the Marky Maker series, I covered, first of all, the concepts, the intro concepts. And those concepts by themselves aren't going to make you profitable, right? You can't just go into the market, look for setups, and expect that to make you money. No, you also have to know when to come into the market, when to look for those setups. And that's why in episode 2, I covered kill zones and timing, right? There's different sessions, specific times where you should be trading. In this episode, I'm going to be covering another critical component of what makes a profitable trader. And in my opinion, that is going to be taking responsibility. So I'm going to be going over some risk management and discipline practices that's going to keep your emotions under control. So with that being said, let's hop straight into the charts. Let me take you one step closer to becoming a profitable trader. I honestly think it's easy for somebody to sit down and talk to you guys just one-on-one about psychology, what you have to do. But I think it helps a lot more for like people that like to visualize things a lot more, like to see it and put it into perspective. Because I was always that kind of person. I needed to see like what that meant, like see a real life example of what it means to literally like revenge trade, what it means to overtrade. When do you typically do those things? What causes you? What are the catalysts? Because remember, if you're just putting a bandage on the wound, that's not taken away from like the problem. Like if you keep getting hurt because you're like falling down because you're skateboarding, right? And you don't know how to skateboard. And instead, what you keep doing, you just put a bandage on the wound, but you keep going and doing the same stuff on the skateboard. You're going to keep falling. You're going to keep hurting yourself. You have to fix the root of the problem before you go and put a band-aid on, right? So that you don't do it again. And so in trading, it's similar to that. Like you shouldn't go and put a band-aid on the wound. You should figure out what is causing these wounds to even happen. And typically this happens, guys. A lot of you guys are just really familiar and have gone through this when the market takes you out before running higher. Now, when does this typically happen? A great example of this is like moves like this. Like this is one of my favorite examples when we take out a liquidity, because you guys know when it takes out lows, new buyers are entering the market and it typically reverses from those areas. And that's my favorite area to buy. But most of the time we get this like nice beautiful buy right from these lows after it takes out all this liquidity to the left and starts reversing, and we get a big move like this. Like this is a pretty solid move, right? You could see we get all the way up here. At this point, like you probably would have been really confident to say that it's reversing. And then you go break even on your trade. And this first move that you caught is the very first liquidity sweep of this move. In the market, if you guys have been learning a lot more about premium and discount, it likes to operate in this premium and discount way where it runs, creates a high, and then starts pulling back. And where does it pull back? It pulls back down to the 0.5 of the move. This is called the discount. So what this means is when it goes below the discount, that means there's new buyers entering the market right here. New buyers at a cheaper price. And these new buyers, they're going to hold their trades until it creates a higher high. And this is what a bullish trend looks like, right, guys? If you just think about it, it will create higher lows and then higher highs. And these people that are buying are then selling their positions once it goes above previous highs, because that's now where price is more expensive. They'll wait for it to pull back down into the discount again and buy again. So you can see here after a sweep of liquidity, it pulls back down. Why does it pull back down? Because while it looks like it didn't really tap into anything here on the 5-minute time frame, if you were to scale down in this exact position, then you would see that there's probably a bunch of rally gaps here on the lower time frame that are being used. Like you can see that we had a bunch of stuff here, like previous lows, 1, 2, 3 previous lows. We took that out, went into the discount, accumulated right here, some orders, and then we ripped up. That is exactly how the market works. And so a lot of people that get into these positions and think that they're going to catch a beautiful trade, they can now go break even. Most of you guys will be getting taken out and then market will continue higher. You have to acknowledge premium and discount and know that even in a bullish trend, an extremely bullish trend, when the market wants to go higher, it's going to always still pull back down into the discount, allow for new buyers to enter the market. It typically also manipulates all these people that thought that they were getting this beautiful position, and then market will continue higher. So how can you avoid this? You have to avoid this by just accepting it. You have to accept that not in all situations, but in most of them, the market will come back down into the discount before running higher. Even in this move right here, it didn't necessarily sweep any liquidity, but you can see if you take it from the bottom of this move to the top, you can see that this bearish candle, it pulled all the way back down into the discount before running higher. This always happens, especially after a liquidity sweep. You wait for it to pull back up, down into the discount, and then continue higher. So that's a strategy that I want you guys to now incorporate whenever you get liquidity sweeps. Wait for it to come back down into the discount, give it some time to accumulate, and then rip up higher towards the expansion. But it's in those situations, guys, where you are looking for this perfect trade and it comes back down, takes you out, and keeps running higher. This is when you guys get impatient, greedy, and you force trades. You start entering positions up here, and this is when the move is already done, right? It's already at this higher high, and now we start consolidating. It might not necessarily reverse on you, but it started consolidating here, guys. You see that? It started consolidating, it built up some more orders, and then ran higher. From this point, if you guys know what an IFEG is from our first episode, we got an IFEG here, we tapped into it, and then ripped higher, right? But you do not want to be putting positions here because that's when you start getting chopped up in this move. You end up blowing your accounts in this move right here. You want to be trading at the bottom in the discount, not in the premiums when people are already starting to sell their positions. Even guys, even if you're seeing an IFEG up here and you know that it's likely going to continue higher, you don't want to be getting in at this area because this is already when it already started the move. You want to get into your trades when it's in the discount, when it pulls back into like the midpoint of IFEGs, when it pulls back and fills an IFEG or taps into like a no wick right here. There's a lot of areas that are high probability. And what causes you guys to make these emotional and undisciplined decisions is when you miss out on moves like this. When you were in a trade, it takes you out of break even and then it runs without you. These kind of situations is what causes a lot of traders to then over leverage, to over trade, to force trades that aren't there. Now, another great example for you guys to picture and visualize when a lot of these emotional decisions are made are in moves like this, when a lot of people, they marry their bias, right? So let's imagine you're bearish on the day. And you get this nice move. You enter, you see it fills this fair value gap, it closes inside of it, and you're targeting the lows. And as it's running, it barely misses your target, and then it runs up and takes you out. Now, what you're going to do is you're going to expect the market to continue going down, especially like this right here. We pulled back up and we closed inside of this fair value gap again. And what you're doing is you're entering more sells because you're like, there's no way we don't take out this low. We just ran down there and barely missed it. So now we're probably going to go down and take out this low. And it just keeps going higher, right? Instead, it creates this bullish IFEG that you may have not saw because you were like, it doesn't matter, it's bearish, it's gonna go down there. And it pushes up higher, and you're continuing to sell every time it creates these new higher highs. But you don't realize that it continues to create bullish IFEGs. The trend has changed here, and now it's going for these highs instead of the lows. And what you did is you married your bearish bias. You thought there's no way that it's not gonna go down here. But if you were just to look at the chart, you would have saw we created an IFEG here. We perfectly stayed inside of it. We ran up higher, created another IFEG. We tapped into it right here, and we ran higher again. That would have allowed you to not overtrade on these losses, on this bullish move, because you would have been able to listen to what the market was telling you. But when you guys marry your bias, that's when a lot of emotional mistakes happen. That's when a lot of overtrading and revenge trading happens, because you barely miss your target and you're married to this bearish narrative that you don't even see what the market is doing. The number one rule as a trader is let the market tell you where it's going. You're not coming into the market to force a trade. You're coming into the market to adapt to what it's doing and take advantage of it, right? And how can we take advantage of what the market is doing? You listen to what it's doing. You look at the price action, you see if the order flow is bullish or bearish. So that's another scenario where we are married to our bias, and then the market does this thing where it barely misses a great target that we were about to take profit on. That's when we end up revenge trading because we barely missed something. We're like, there's no way it doesn't go back down there. And that is a great scenario of where a lot of traders also tend to overtrade and lose. Now, the third example that I'm going to cover in this episode is going to be when it's consolidated. I went over kill zones in the last episode. And for those of you guys that know, you have to trade during specific times, right? You cannot trade during a time that the market isn't going to be moving at, because what's going to happen is this right here. It's going to consolidate. It's going to move sideways. And this typically happens pre-market. Pre-market, it always consolidates, Asia opens up, and you see this massive expansion. Then you see that Asia session ends, and then the volatility kind of dies off. Like, take a look right here. Asia session's over, And now we're just dead volatility right here. We're moving sideways. Even the start of London session was pretty choppy. And so when you guys aren't trading during prime trading sessions, you're going to be facing this consolidation right here. And here's the thing, especially with a lot of very experienced traders that still end up making these mistakes, including myself. When we know where the market is going overall, what you guys tend to do is you're like, okay, it's time for London session. I know that the daily narrative is bearish, for example, right? So now you're going to come into the London session, you're going to be like, it's time to sell. And it's going to move down, and then it's going to move up, and then it's going to move down, and it's going to move up, and it's going to move down. You're going to be like, oh, finally it's selling. And then it moves up and takes you out. This kind of market is a terrible market to be trading because no matter what and how experienced you are in finding the daily narrative, you're not going to perform well if you're trading a session like this. If you notice after 2 or 3 candles that it's just literally moving sideways like this, that's when you turn off your computer screen. If you don't have rules to stop trading after a certain amount of losses, it's not going to allow you to zoom out and take a look at the chart. Because while you're inside of the market, it doesn't look necessarily like it's consolidating. It doesn't always do that. Because especially when you're on the 1 minute time frame, you're like, oh, these are pretty massive moves. When in reality, they aren't. They're very choppy moves like this right here. And no matter what the narrative is, you're going to get taken out over and over again because it just literally takes out highs, goes to lows without actually breaching any of them. It doesn't break out and go towards any of these locations. It will just move sideways and manipulate on you. You have to understand that days like this is a Monday. You do not want to trade. And I'm going to pull up a PDF for you guys on this because I think it's very important that you guys visualize and understand that there are certain days of the week that you should not be trading. So Monday is the worst possible trading day of the week. This is a PDF that I made a little while ago when there's no news. First thing, don't trade no news Monday with more than like 0.5% of your account. Because if you want to trade Mondays, you're going to likely risk encountering these kind of situations where there's no news. And if there's no news, there's not going to be any manipulation on the accumulation in the market. So whenever it's building up highs and lows, there's not going to be any factor that's going to manipulate both those highs and lows and actually cause the market to move in a specific direction. That's not going to happen on a Monday with no news. Tuesday, if Tuesday does have news, it's going to manipulate on Monday's highs and lows. And then the market is off to a great start, right? But you can see here, this is my Forex factory. Monday, September 16 had no news. Tuesday did have a news event, and Tuesday actually manipulated while Monday's range was just consolidating. And there are different profiles of the week, understanding where it's going to go. But what I came to conclusion is that Thursday is one of the most high probability days because Thursday almost always has a news event on the Forex.com calendar. So Thursday is one of my favorite trading days, and that's the one where I actually would size up on. So here's my little risk management journal where I only risk 0.5 on Mondays because Mondays are just the worst day of the week. You don't want to start your week off by risking too much. And then I have a little 1, 2, 3 RR, which if I am risking 1%, I go for 3. If I'm risking 0.5%, then I'm going for 1.5%. Pretty much 3R of whatever I am risking. And then Wednesday and Thursday are typically days where I do trade a little bit more. Why am I low risk still on the first week of the month? That's because every first week of the month, we have NFP on Friday. It's every single Friday of the first week of the month, we have the NFP, non-farm payroll. And this is a very bad time to be trading because it's one of the strongest, highest impacted news events. So typically the day before, we create those highs and lows I was showing you. So even though it's Thursday, it typically just consolidates so that NFP has highs and lows to take out. But the first few days approaching NFP are days that I still end up trading. And then the weeks after that are very high probability. And then the last week of the month is always high probability because it's running towards wherever the monthly candle wants to close, right? Every single month, there's a monthly candle as well. And during the last week, I see the most amount of volatility running towards where it wants to close. It's the easiest to read. So this is another thing that you guys have to take into consideration when you guys are trading. Remember, you have to take responsibility, and psychology is one of the most important things in trading. I can give you guys a 60% win rate model, and you guys are probably still going to lose money because of these other factors, right? Over trading, over leveraging, not following your rules. But when you guys incorporate a system and you guys actually take responsibility for your trades, then even if you trade, you have a good system that will allow you to succeed, allow you to be profitable, even if you take a loss. Like on Monday, you take a loss, you're only risking 0.5 per trade. You have a certain amount of trades that you're taking. And at that point, you zoom out, you're like, oh, it's consolidating. Let me just hop off because it's literally just going to cause you to lose money and blow your account. So with that being said, guys, This is episode 3 of the Market Maker series, focusing on taking accountability in specific situations where a lot of traders tend to get emotional and trade the wrong way. So take into consideration these factors, take into consideration the kind of risk management that you should have, and why specific weeks and specific days of the week have a higher probability and lower probability. So with that being said, guys, I'll catch you guys in the next episode. Hope you guys enjoyed. Peace.